Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show of talking about the charts and looking at the markets, and lots of interesting things as always to go through this week. And I also want to have a look at all your stock codes at the end. So any stocks you're interested in, get those stock codes ready towards the end of the session. We'll go through all of those and get a technical look at what's happening in those stocks. Now, as always, everything today is general commentary only, doesn't take your personal situation into account. Having been through all that, let's get straight into our charts. So, our first chart for this week is, of course, the ASX 200, and it's been a week of back and forth movement in the ASX 200. On the surface, it mightn't seem overly eventful, but there's actually a bit more to it. I'll explain what I mean in a moment. And there's also some important price action in the S&P 500 to discuss. And this really is important to understand. I'll show you how this situation in the S&P 500 has played out in the past. I think that's really interesting. But before we get to that, let's start with this latest price action in the ASX 200. So after this exceptionally strong rally, prices have paused this week. And the pause coincides with the 200-day moving average, which comes in just beneath where prices currently are. We spoke about that last week. I'm going to talk about the 200-day moving average in relation to the S&P 500 in a moment, so I don't want to spend much time on it just here. But this pause we're having, it's at a very natural point following a larger rally to have the market consolidating around that 200-day moving average. What I do think is interesting and worth discussing now is what's going on with the 50 and the 100-day moving averages, because they continue to turn higher after 2 months of declining. So back here from February, 2 months of declining, and now they're starting to round upwards. And most importantly, prices, the ASX 200 price is consolidating above the moving averages. So I think it's still early, and there's more work to do before we can say prices are established above the moving averages, like what we had in the previous year, established above the moving averages. I think there's a bit more to do before we can say that, but this is how it all starts. This is how getting prices established above moving averages starts. Nearby support comes in at around 8,100. You can see this blue shaded area stretches across, takes in several lows and highs going back into mid last year. And of course, just below there, we have the moving averages themselves, which is also they also provide a support range. What I want to see here and what I want to see now is that the ASX 200 holding on to most of these gains from the April low. And the more that it can hold on to, the more of these gains that it can hold on to, the stronger the underlying buying interest on dips. And that's going to be an important thing to observe when we do get a pullback. And another thing which I think is really important here is that this isn't just a rally in CBA or a few of the big cap stocks. I want to show you the ASX 200 on an equal weighted basis. And so this is it. This is the ASX 200 equal weight. And so, of course, if you're not familiar with the equal weight, it simply ranks every stock equally. So the biggest stock and the smallest stock in the top 200 are ranked the same. And this is having an even stronger rebound. The rebound in the equal weight is even stronger than that of the ASX 200. What I think this shows is that this isn't what we're seeing in the ASX 200, the market generally. It's not a narrow recovery led by a few big stocks. It's a broad-based rally, and that's good. I think that broad participation is a good sign for the durability of a recovery. It's not being led just by a handful of stocks. Coming back to the ASX 200, as I've said, the key now is for prices to become established above the moving averages. I've been talking about proceeding with cautious optimism for a few weeks now. Pretty much since we started having this recovery, we talked about maybe averaging into ETFs and getting some sort of exposure. And I think that approach of cautious optimism is, I think that remains. I don't think that's changed. I've continued to gradually move cash back into the market. I'll show you a stock I bought a little bit later. And also, of course, the motion trader signals are providing new opportunities, and that's where I'm finding my own new stocks, which I'm adding to my portfolio. If you're not a motion trader member and you're not seeing those signals, maybe think about taking the free 2-week trial, seeing the sort of work that I'm doing with the buy signals and the calculated exits for like how we can participate in uptrends when markets are trending, and getting out of stocks when things are falling, getting back in when prices recover. Move on to the S&P 500 now. But first of all, if you're getting some value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Tell me what you think of the market. Whatever you like to leave, short comment. It really helps because it shows YouTube that you're engaging. Then YouTube shows more people, and that helps me. So please do those things. Like and quick comment. Now let's jump over to the S&P 500. And so this has been one of the great rallies, not just from the low, but also from the more recent low in towards late April. One of the great rallies. The S&P 500 has last week. So just last week, the S&P 500 completed that with 9 up days in a row. So 9 up days in a row. The last time that happened, it was back in 2004. So a touch over 20 years ago. And these big winning streaks don't happen often. There are only 9 of them since 1980 that you get these 9 up days in a row. And what we find is that most of them lead to further gains over the weeks and months ahead. And now this is an important point. I said most of them lead to further gains, not all of them. So when you hear these historic notes, and you'll hear them when you're around the internet or the news services, you may hear historic notes like that, like 9 up days in a row, and that's great. It's all really important. But also just make sure you couple that information with analysis of the price action, and understand what's going on there. Because as I say, they don't all lead to further gains. So what do we have? What do we have on this chart? So stepping back, analysing this. Firstly, S&P 500, it's got the V-shape recovery of what appears to be a panic-driven sell-off low. V-shaped recoveries. We often associate these V-shaped recoveries with high-volume events. And of course, this sell-off was very much a high-volume event, extremely high volume. And the strength of the rebound shows that buyers are actively bidding up prices. So that's a positive event, as opposed to a rally which really can't get momentum and just stays quite flat and then becomes prone to rolling over again. So the strong recovery, really an important and positive aspect. Another point is the S&P 500 has recovered more than 50% of its losses. So from the high to the low, 50% of the way back coincides with this resistance. It was resistance, now supported around 5,500. So that's a 50% marker. So we're above there. And the relevance of that is that once the S&P 500 recovers more than 50% of a bear market, this is over a 20% decline, so it's a bear market. When we historically look back, once the S&P recovers more than 50% of a bear market, the low is generally in. So of course there can be exceptions, but I think the odds favour that the sell-off was indeed a panic-driven event and not the start of a larger bearish period. So prices are also now above this resistance, which I just noted at 5,500. I think the fact that prices are breaking back above these lows, you can see these two lows from March, prices now back above those lows from March. I think it tells us that the sell cycle really has disengaged. So this is where it gets interesting in the near term. So this rally takes the S&P 500 back to the 100-day moving average. And just above there is the 200-day moving average. Let me quickly put that on. So I'm going to put on a simple 200-day moving average. So you can see the this slower or this less reactive moving average is the 200-day, and there's a 100-day below that, and the 50 below that. And so the 200 and the 100 in particular, they're key technical levels, and they're in close proximity to each other. So is this something to worry about? That prices have rallied back into these moving averages, and what's interesting? It's interesting to look back at a couple of V-shaped recoveries or V-shaped reversals from recent years, and what's happened when they've reached these moving averages. So let me just compress this a little bit. Let me just jump back. So I'm going to go back to. I'm going to show you two. We'll just start here with the recovery out of the COVID crash lows. So, like we just experienced, rapid sell-off and then an almost equally rapid recovery, prices rallying strongly once that low was in. And what you notice, once prices got up to the 100-day moving average, so this is this middle line, that's the 100-day moving average, there was a pause, market paused, consolidated for about 2 weeks. But also notice how it held on to most of the gains. We had a big rally, and then the market held on to most of those gains. So that was important. Prices then broke higher and then quickly rallied through the 200-day moving average. The 200 didn't really cause prices to pause at all, and then the rally continued on. One more example I want to show you. It was just a little bit over a year earlier. It's this V-shape. Firstly the sharp sell-off and then the V-shaped recovery. This was during December 2018. And it's interesting to reflect on what caused this sell-off in December 2018. And a big part of it was escalating trade wars with China. So the same scenarios or the same events tend to repeat over time, that people get worried about, people panic, and then the worst doesn't happen and things recover. But that's just coincidental. So the market recovers off that low, starts to rally. Look where it pauses. First significant pause is at the 100-day moving average. So about a week and a half it pauses there, gets through there, then it pauses again at the 200-day moving average for a few days before rallying on, and then prices continue up. And so bringing this back to the current day, will the same thing happen here? Will we get some sort of pause around the 100 and the 200-day moving average? We're already getting a bit of a pause around the 100. Of course, we don't know how this is going to play out, but I think if the S&P 500 can hold on to most of its recent gains and consolidate above this support here around 5,500 and just below these moving averages, well, then it sets up the potential of building a platform that could support higher levels as we go into the weeks ahead. I think the play here is to approach the market from the long side and be looking for opportunities that stand out. So not just any old stock, but stocks have to meet the right criteria. For me, that involves being above rising moving averages, breaking out of ranges, buying into strength, not just buying something which appears to be down and out. It's got to stack up. So that's why I say looking for opportunities that stand out. But until prices can become established, I'm just going to take off that 200-day moving average, and still prices become established above rising moving averages, I'm still happy to hold extra cash and be conservative with adding risk. I think there's still plenty of scope for conditions to remain difficult. Yes, there's some positive aspects to this chart, and I think we can, as I say, conservative optimism is probably the way to approach this, but also just being conservative with risk. Because as I say, there's plenty of ways this can still remain difficult. As I said last week, don't overlook the possibility that prices can rally a bit further, but then maybe from there coming back and trading within a larger range for the maybe the second half of the year. It's not simply a case that prices have to either make new highs or make new lows. There's a big middle ground where they can chop sideways for months, making it difficult. So I don't think now's the time to get aggressive, but I do want to be positioned on the side of momentum, which at this point is upwards. And as I said with the ASX 200, it's cautious optimism. I think that's the play here at the moment. Now we're going to jump over to the US small caps in a moment. I've got the small ordinaries, the local small caps, the commodities. Any stocks you want me to look at, we're going to do that. Of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come in, costs very little. I think you're going to get a whole lot of information that you're not going to get elsewhere by coming on in. I think you find it interesting. So think about doing that if you're not a member. All right, let's start. Let's start with the Russell.